It's great to be here today with some of the White & Case Mining and Metals core team. We've spent the day thinking about the future of the sector and ensuring that we are there for our clients as the sector evolves.
Looking at the Americas, I see some really good opportunities in the near term and some themes that we've been focusing on to focus our practice. I would sort of put them in a few categories. One being growth projects, particularly I think in the mining sector in Latin America. And that's being driven by new technologies requiring new commodities. And we sort of see that as the sort of battery mineral supply chain. And that's going to be one area that we're going to focus on. Another is in the sort of resurgence of the metals sector in the US. Really being driven by the current administration's policies, and we're starting to see some activity there, which is quite exciting and a good opportunity for us to sort of bring a cross-practice approach to that sector, leveraging our trade compliance expertise. I think one other sector we're seeing a lot of activity is in the gold sector. There's been some significant consolidation, and we're going to see a lot of M&A activity sort of flowing on from that.
There's been generally a lack of credit supply over the last few years, and most commercial banks' project finance portfolios are geared toward power and infrastructure projects, not primarily mining. So there's a keen appetite for banks to lend into projects in South America. I think ECA involvement is key for financing projects in the area. That provides much more liquidity, and the maturity profiles of these deals are extended by several years when there's ECA involvement. So I think the key drivers for projects in LATAM will be the ECAs and the equity story of these projects. If it's a strong sponsor, a strong offtake contract, I think those are key things for successful projects.
People are fairly optimistic about what the next, say, 6 to 12 months hold for companies looking to access the U.S. capital markets. I guess specifically I'd talk about the high yield product, which is one that, as people know who follow that space, can be a little cyclical at times in terms of when the markets are open and closed. But I think we're in a period right now where, after a sluggish start to the year, it's really opened up. And so you've got a product where the investors are willing to take some risk, which lends itself well to some of the mine operators that are at different stages in their lives.
Drivers in part have been rising gold prices, but more importantly it's the position we are in the cycle. We saw 2012, 2016 reduction in exploration, which means now that all of the lower cost assets have been acquired. We're finding high cost exploration, and effectively M&A has just become cheaper than exploration. Following on from that, the Newmont Gold Corp and Randgold Barrick mergers, and then the subsequent joint venture between Barrick and Newmont. Each of them have identified non-core assets, and they said that these are assets that they don't want to focus on, and therefore have got a stated ambition to dispose of assets over the next 2 years. The interesting thing is going to be who will buy these and how are they going to be able to fund that. And I think that is going to be a significant challenge to the majors in the disposal process, because we may find that it will not go as they intend. And we see a range of mid-sized players who are going to start getting squeezed. They're not in the right place on the cost curve, but they're also not going to be able to fund the acquisition because we're not finding capital available.
I think the Chinese gold groups are being very expansionary. If you look, for example, at what Zijin has been doing over the last few years, they've made some really major strategic investments in the sector, and the Nevzun takeover is a really good example of that. And I think the China gold players will continue to be aggressive in the sector, and they're going to sort of fill that gap that we just spoke about around who are going to be the buyers through mergers. It's interesting to see, there are some players in the market that have adopted a slightly different approach. So if we look at Newcrest, the rumours are they were talking about mergers, but they've now gone down the path of actually doing sort of some really major project-focused investments, but again, in a way that sort of manages the risk. And so, again, the executives are taking a very prudent approach because they still have institutional shareholders that remember the sort of over-expenditure that took place during the last boom part of the cycle.
Battery supply chain minerals and the new the minerals that will support electrification and decarbonisation of the economy. Really, there being such a huge area of growth in the sector, and also interestingly bringing new investors into the sector. And as we have just spoken about, it is proving to be increasingly difficult to attract, in particular, equity investment into the traditional commodity space, particularly at the junior end of the market. However, interestingly, we see that in some of the, let's call them new energy minerals, lithium, cobalt, vanadium, and so on, that actually some of the responsible investment vehicles, some of the new energy funds, some of the battery mineral funds that have been set up are actually now providing new and interesting sources of capital to the sector.
And it's interesting because it's not just, you were talking about new sources of capital in, but we're also seeing the automobile industry really now thinking about access into lithium in particular. We've seen Volvo recently sign up a new supply deal into China.
We shouldn't underestimate how strategic the Chinese have been in the battery space. They have made some really major investments in battery production. They're being really strategic around trying to position what the technology is going to be that gets used, and we've seen a few examples of things like that.